Comfort Systems USA just absolutely shattered consensus expectations for Q2 2026. I mean, a massive beat across the board.
Yeah, they really did. The stock popped like 12% right out of the gate after the print.
Exactly. So let's look at the top line. Revenue hit $3.27 billion. That is a 50.3% increase year over year. And diluted EPS came in at 12.53.
Which is just nuts. That's up an astonishing 92% from last year. And management guided for continued supportive conditions through the rest of the year.
Right. So welcome to a brand new deep dive. Today we are unpacking this incredible earnings report for Comfort Systems USA. Ticker is FIX.
We are pulling apart their official Q2 earnings presentation and the 10Q filing for you today.
Because our mission here is to figure out how a company that basically deals with HVAC, plumbing, and wiring just posted software-level growth numbers.
Yeah, the scale of these results really demands a serious look under the hood.
Absolutely. What do their financials reveal about the hidden mega trends in the broader economy? Because a 50% jump in revenue for a company already operating in the multi-billions, that is exceptionally rare in physical construction.
Right. I mean, this isn't a tech startup scaling software at zero marginal cost. This is a company physically pouring concrete and installing industrial chillers.
Okay, let's unpack this. We have the revenue and the EPS, but the absolute standout metric in this filing is the cash flow.
Oh, yeah. The operating cash flow number was wild.
Q2 operating cash flow was $1.14 billion. For context, in Q2 of 2025, it was $252.5 million.
Which is why the CEO, Brian Lane, explicitly called this completely unprecedented in their press release.
Generating over $1 billion in operating cash flow in a single quarter for a mechanical contractor feels less like plumbing and more like a license to print money.
It really does. But to understand that massive 1.14 billion figure, you have to look at how commercial contracting actually accounts for its money.
Right, because cash flow in construction is notoriously lumpy, isn't it?
Exactly. It comes down to a combination of volume, market timing, and the mechanics of percentage of completion accounting.
Which basically means you don't wait until a multi-year project is handed over to recognize the revenue, right?
Right. You book revenue over time as you incur costs, but the actual cash flow operates on a parallel, often delayed timeline.
Meaning the revenue looks great on the income statement, but the cash isn't necessarily sitting in the bank account until the project hits certain milestones.
Exactly the dynamic at play here. The filings specifically note favorable developments on projects nearing completion.
Like change orders.
Yeah, exactly. In commercial HVAC and electrical work, projects are always subject to change orders. A client decides halfway through a build that they need, higher density cooling.
Or a totally different electrical layout.
Right, so Comfort Systems does the work, but negotiating the final price of those changes can take months.
So when a massive multi-year project finally closes out and those change orders are formally approved and paid,
a tidal wave of cash suddenly hits the balance sheet. Management highlighted roughly $43.1 million in favorable developments early in the year.
compounding on top of just a massive increase in raw volume.
Yeah, and that volume is largely driven by what they call same-store revenue growth, which sits at 43.8%.
Okay, when we hear same store, we usually think of like a retail chain comparing sales at an existing location versus a new one. How does that translate to an HVAC contractor?
Well, it's the same fundamental principle just applied to regional operating companies. Comfort Systems has a history of acquiring successful local contractors.
So same-store revenue isolates the organic growth of the subsidiaries they already owned a year ago.
Exactly. It deliberately strips out the artificial revenue boost of just buying another company.
Wow, so that 43.8% number tells us their core underlying business is operating at a historically high frequency.
They are executing incredibly efficiently against a massive backlog of signed contracts.
A backlog which currently sits at $14.06 billion.
Yeah.
That is up from $8.12 billion a year ago.
It's massive.
Having $14 billion of guaranteed work waiting in the pipeline begs an immediate question, though. Where exactly is all this money coming from?
Yeah, who is writing these massive checks to a physical infrastructure company?
Right. When you dig into the sector breakdown in the 10Q, the macroeconomic narrative becomes crystal clear.
Comfort Systems is divided into two primary segments. The mechanical segment, which is the HVAC, plumbing, and cooling side accounts for 70.3% of their revenue.
And that segment pulled in $2.3 billion for the quarter, which is up 40.2%.
Right. And the filings explicitly attribute this to same-store activity in the technology sector. They specifically name-dropped operations in Texas, Indiana, and North Carolina.
And those three states are not random dots on a map. They are rapidly expanding hubs for commercial real estate and, digital infrastructure.
Exactly. Then you look at their electrical segment, which handles the complex wiring and power distribution.
That accounts for 29.7% of revenue, hitting $969 million. But it grew by a staggering 81.2%.
Yeah, a portion of that growth came from strategic acquisitions integrating companies like Hunt, Fyan-Zylstra, and Meisner, but there was also intense organic growth.
The filing actually singles out a $186.6 million same-store jump in the Texas tech sector for electrical alone.
And here's where it gets really interesting for you. When you look at their $14.06 billion backlog, 57.6% of it is concentrated purely in the technology sector.
Compare that to manufacturing at 17.5% or healthcare at just 7.4%.
Which is wild because healthcare used to be the absolute gold standard for complex, high-margin mechanical contracting.
Right, but now technology is completely dwarfing it. I mean,
Right.
we think of the tech sector as software engineers writing code or AI models living in the cloud
But Comfort Systems USA is building the physical homes for that cloud.
because these massive data centers are essentially giant, incredibly hot toaster ovens full of servers.
Exactly. The heat generation of modern tech infrastructure is the ultimate bottleneck for the entire industry right now.
If we connect this to the bigger picture, you can think of data centers today similarly to the industrial factories of the 1920s during mass electrification.
Right, you couldn't just plug a massive assembly line into a standard wall outlet back then.
And today, a modern AI server cluster draws an astronomical amount of electrical power, and every watt of that power eventually turns into heat.
So you can't just put a heavy-duty commercial air conditioner on the roof and call it a day.
I imagine the engineering demands have fundamentally changed.
Oh, far from it. Traditional data centers were relatively simple to cool with just forced air,
Right?
but modern high-density compute requires immense, custom-engineered fluid cooling systems. We are talking about pumping liquid directly to the server racks.
Wait, directly to the racks, integrated with the high-voltage electrical distribution.
Yes. And if a pressurized coolant pipe leaks onto a rack of specialized processors, it destroys millions of dollars of equipment instantly.
So the barrier to entry to build these facilities is immense.
Exactly. Local mom-and-pop HVAC shops simply do not have the engineering talent, the bonding capacity, or the specialized labor force to bid on a billion-dollar data center.
Which leaves massive, sophisticated players like Comfort Systems sweeping up the demand.
Precisely.
But growing revenue by 50% usually breaks a physical supply chain.
Yeah,
I mean, it costs a tremendous amount of money to move that fast.
it does.
Are they actually keeping any of this cash, or is it all flying out the door to pay for emergency labor and overtime?
Well, revenue is just a vanity metric if it destroys your margins, but their gross profit margin actually expanded to 25.9%.
Up from 23.5% in Q2 of 2025.
Right. That was driven by a $313.3 million increase in same-store gross profit, primarily from improved execution in that mechanical segment.
I do want to push back on their operating expenses, though. Looking at their SG&A selling, general, and administrative expenses, the total dollars spent actually increased to $287 million.
Yeah, the filing attributes this to higher headcount and increased labor costs.
So they are actively spending more money on administrative labor and expanding their project management teams in a highly competitive market.
But their SG&A as a percentage of revenue actually decreased from 9.7% down to 8.8%.
Wait, so they are spending more on overhead, but overhead is shrinking relative to the size of the business?
Yeah, it sounds backward, but it is just classic operating leverage.
Is there a breaking point where the physical reality of a labor shortage catches up with the math, or is this just infinite scaling?
Well, what you're describing is crucial to understanding why their net income grew by 91.3% while revenue only grew by 50%.
Right.
In a regional contracting office, you have fixed costs, you have a branch manager, an estimating team, an HR department, and, a lease on a warehouse.
Okay.
If that specific branch grows its revenue from $100 million to $150 million because of a local data center boom, they don't need to lease half a new warehouse or hire half a new branch manager.
The administrative structure is already in place.
Exactly. The fixed costs stay relatively flat. So the gross profit generated by that extra $50 million in revenue flows almost entirely to the operating income line.
That creates a compounding effect on profitability.
It does. Now, regarding your point about a breaking point, operating leverage is not infinite in a physical services business.
Right. Eventually, a regional branch hits maximum capacity.
Yeah, you are forced to open a second office, hire a second branch manager, upgrade your enterprise software. At that point, SG&A steps back up.
But right now, Comfort Systems is in the sweet spot where their existing national infrastructure is effortlessly absorbing the new tech demand.
Right, so every new dollar of revenue up to a certain structural ceiling is exponentially more profitable than the last.
That makes sense. But we are looking at the absolute best-case scenario here. We have to balance this deep dive by examining the very real headwinds management is facing.
Definitely. Connecting their current success to their future viability means reading the risk factors.
And management is remarkably transparent about the operational strain of the 10Q.
Yeah, in their forward outlook, they explicitly acknowledge the unprecedented demand environment, but they quickly pivot to list severe ongoing challenges.
Like the intermittent supply chain shortages, delays in material deliveries, and the specialized labor costs we just discussed.
The supply chain for specialized industrial equipment is incredibly fragile right now. You were talking about 50-ton industrial chillers and custom switchgear.
Right, these aren't sitting on a shelf at a local wholesale supply house.
No, they require custom fabrication with lead times that can stretch for over a year.
Wow.
And if a critical electrical component is delayed, it stalls the entire construction schedule. In commercial contracting, time is risk.
Because delays mean your expensive labor force is standing around waiting, which actively destroys the profit margins of a fixed-price contract.
Exactly. Their stated mitigation strategy in the 10Q is, quote, ordering materials on an earlier timeline and seeking to collaborate with customers to share supply risks.
Translating that from corporate speak, it means they are securing manufacturing slots way in advance.
Yep.
And more importantly, they are writing contracts that push the volatility risk back onto the client.
Right. If the price of copper spikes between the signing of the contract and the installation, they have escalation clauses, ensuring the tech company absorbs that cost, not Comfort Systems.
So by front-running the procurement process and restructuring their contracts, they are building a fortress around those expanded margins.
They are. But even with risk sharing, they are still operating in an uncertain macro environment.
So what does this all mean for the broader economic outlook? Management mentions preparing for a wide range of economic challenges, including a potential recession.
Right, but they also state they expect supportive conditions to continue through 2026 for their tech and manufacturing customers.
I look at a $14 billion backlog, and I have to question how real a recession threat actually is for them.
That's a fair question.
If a standard economic downturn hits, don't they just keep working through the billions of dollars of contracts they have already signed? Doesn't that insulate them?
Well, this raises an important point about the nature of construction backlogs. A backlog is a fantastic buffer, but it is not an ironclad guarantee of future revenue.
It's effectively a snapshot of intent.
Exactly. To understand the vulnerability, you have to read the safe harbor statement in the SEC filing. The safe harbor is where a company outlines every material risk that could alter their forward-looking statements.
Right, the section where they had to admit everything that could go wrong to protect themselves from liability.
Yep. In that section, they explicitly warn of financial difficulties affecting projects, vendors, customers, or subcontractors.
And crucially, they mention unexpected adjustments or cancellations in our backlog.
Right. A tech giant's capital expenditure budget is entirely dependent on the perceived future return on investment of artificial intelligence.
So if the broader economy enters a sustained recession, or if AI monetization doesn't materialize on the timeline Silicon Valley expects,
those tech companies will drastically reduce their capex.
and if they pause construction on a planned data center, that massive contract sitting in Comfort Systems' backlog evaporates before it ever turns into cash flow.
Furthermore, they are still subject to physical world constraints like weather seasonality.
Right, their first quarter is historically slower because winter weather fundamentally limits outdoor construction activities.
The tech boom is smoothing out some of that seasonality because data centers are often massive indoor mechanical installations once the shell is up.
But the core lesson remains. A robust backlog protects a company from a mild, brief economic dip. It does not protect them from a systemic freeze in corporate capital spending.
That is why management is walking a tightrope, maximizing the historic demand while aggressively managing their supply chain risk in case the macro environment shifts.
It really is a phenomenal case study in managing hypergrowth within the constraints of the physical world. Let's briefly recap the narrative of this Q2 filing for you.
Comfort Systems USA is leveraging a historic boom in technology infrastructure to drive a 50% increase in year-over-year revenue.
And they are executing with remarkable efficiency, utilizing operating leverage to expand their margins and drop a 90% growth rate straight to their bottom line.
Generating over $1 billion in operating cash flow in a single quarter.
And they're doing all of this while navigating complex supply chain bottlenecks and labor shortages by heavily restructuring how they share risk with their clients.
They have positioned themselves as the critical bottleneck. The digital economy simply cannot expand without the heavy, complex mechanical infrastructure they provide.
Which brings me to a final thought I want to leave you with to mull over. If nearly 60% of a blue-collar mechanical contractor's future work is now tied directly to the technology sector, it exposes a profound fragility in the broader economy.
Yeah, it really does.
We tend to separate the digital world of software from the physical world of construction. But this 10Q proves that the physical hard hat economy is now inextricably tethered to the capital expenditures of a few major tech companies.
If the current spending on artificial intelligence infrastructure slows down, the ripple effects won't just hit software developers.
Exactly. They will immediately impact the companies pouring concrete, running pipe, and pulling wire in places like Texas, Indiana, and North Carolina. The physical economy is entirely dependent on the cloud continuing to grow.
It's all connected.
Thanks for joining us on this deep dive into Comfort Systems USA. Be sure to follow the show for our daily earnings coverage and keep your eyes on the numbers.